Something shifted this past stretch, and almost nobody said a word about it. Not the big financial networks. Not the anchors who spend all day telling you exactly what to be afraid of. Not the trading desks that watch this precise relationship for a living. They saw it. Of course they saw it. They just have no reason on earth to point it out to you, because the thing that moved is one of the quietest, least discussed signals in the entire precious metals world. And the people who understand it tend to make their money while everyone else is looking somewhere else. I am talking to you directly right now, especially if you have spent a working lifetime building up a retirement account and you feel that low hum of worry every time you turn on the news. This is not about chasing a hot tip. This is about a measurement, a ratio, that just reached a level most people have never heard of and would not think to check, and about what that reading has meant, historically, for the metal sitting quietly in the corner of the market. By the time we are done here, you're going to understand this thing better than most people who talk about metals for a living, and you're going to see why the silence around it is the most interesting part of the whole story. So let me give you the first real piece right away, because I do not believe in making you wait through a wall of teasing before you learn anything. The number in the title is the gold-silver ratio. All it measures is how many ounces of silver it takes to buy a single ounce of gold. That is the whole thing. When that number climbs, it does not mean silver got expensive. It means the exact opposite. It means silver got cheaper relative to gold, and it already was. A rising ratio is the market quietly marking silver down while everyone stares at the gold price on the screen. And right now that ratio is sitting up in a band it only reaches when fear is running the show. Here is why that matters to you, and not just to some analyst. For most of the modern era, that ratio has spent its time somewhere in a working range, the 50s, the 60s, occasionally drifting into the 70s. When it stretches up toward the top of that range and beyond, history says one of two things is coming. Either silver is about to fall further and drag gold down with it, or the gap is stretched so far that it snaps back, and when it snaps, silver does not just recover. Silver runs. It runs harder and faster than gold, because it was the thing that got beaten down the most. That snapback is the whole reason the smart money watches this number. And it is the whole reason the people who profit from your fear would rather you never learn to read it. Now let me take you back not very far at all, because the clearest lesson this ratio ever taught is recent enough that a lot of you lived through it and did not realize what you were watching. Go back to the spring of the year the whole world locked its doors. Panic like almost nobody alive had felt. Markets did not just fall, they seized. And in that moment of pure terror, money did what terrified money always does. It ran to gold, and it fled from anything that felt industrial, anything tied to a world that had just been switched off. Silver got left for dead, and this ratio, the one nobody talks about, spiked to an extreme it had not touched in decades. It shot up toward a reading so high it was almost hard to believe, a level that told you silver had never, in the memory of most living investors, been this cheap compared to gold. Picture the kind of person living through that. A steady, careful saver. The sort of man who had quietly bought a little physical silver over the years, tucked it away, never bragged about it. In that spring he would have looked at his stack and felt like a fool. The financial world was screaming that the old safe assets were finished, that industrial metal was a relic, that he had bet on the wrong thing. Every instinct in his body would have told him to sell, to cut the loss, to get into cash and hide. And that instinct, that perfectly human urge to make the pain stop, is exactly the customer the trading desks are waiting for. A frightened holder dumping metal into the very bottom of a panic is not a victim of the market. He is the product the market runs on. But watch what happened next, because this is the part that never made the evening news. From that extreme, the ratio did not sit still. It compressed, and it compressed hard. Silver came off the floor, and it did not crawl. It outran gold for months. Gold rose too. Gold did well. But silver went from something the world had left for dead to one of the strongest things in the entire market in a matter of months. The man who felt like a fool in the spring was, by late that same year, sitting on one of the sharpest recoveries of his life. He did not do anything clever. He just did not sell his metal into the panic. The gap snapped back, and the metal that had been marked down the most is the metal that ran the most. That is not a story I am spinning. That is the arithmetic of the ratio doing exactly what a stretched ratio has always eventually done. And this is the moment I want to stop and speak to you plainly, because we have arrived at the part of this where the stakes stop being abstract. If you are watching this and you have real money in a retirement account, a 401k, an IRA, the savings that are supposed to carry you through the rest of your life, then the single most dangerous thing you can do is what that frightened saver almost did. Sell the wrong thing at the wrong moment because a screen and a scared anchor told you to. That is why I want to tell you about something a lot of retirees have quietly been doing, and it fits this exact story. The biggest, most sophisticated buyers on the planet, the central banks of entire nations, have been accumulating gold at a pace we have not seen in generations, buying on the order of 1,000 tons a year for several years running, roughly double the pace of the decade before. They are not doing that for excitement. They are doing it to protect themselves from a world that suddenly looks less stable. And here is the part almost nobody tells you. There is a completely legal, established way for an ordinary American retiree to do the very same thing inside the account you already have. You can move a portion of that 401k or IRA into physical gold and silver, real metal, held for you, without cashing out, without triggering taxes, without an early withdrawal penalty. It is called a self-directed precious metals IRA, and this is not some insiders-only club. If you have $100,000 or more in any retirement account, this is exactly the kind of thing it was built for. If you want to understand how it works, I put together a free guide that walks through all of it. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. No pressure, no obligation. Just the information, so that if the world gets loud again, you already know your options instead of reacting in fear. Now let me bring you back to the ratio and go a layer deeper, because the reason this reading matters is not only about panic and rebound. It is about something structural underneath silver that most people have no idea exists. Here is the part that actually changes how you should think about all of this. Silver is not simply a smaller cousin of gold. It behaves like two things at once, and that split is the key to everything. Gold is hoarded. When somebody buys gold, it tends to go into a vault or a drawer or a central bank reserve, and it sits there essentially forever, adding to a pile that only ever grows. Silver is different. Silver gets used up. It goes into solar panels, into electronics, into the guts of the electrified, connected world we are all building, and once it is dispersed in tiny amounts across 1 billion devices, it is largely uneconomic to ever get back. It is burned, in effect. And the silver market has now run a supply deficit for several straight years, the world consuming more than it produces, drawing down the above-ground stockpile to cover the gap. Most silver does not even come from silver mines. The majority of it comes out of the ground as a byproduct of mining other metals, which means that even when the price of silver rises, supply cannot simply spring up to meet it, because nobody opens a copper mine to chase the silver. That is the deep truth the ratio is hinting at. Silver can be marked down on a screen for a while, but the physical shortage underneath does not care what the screen says this morning. Let me name the enemy plainly now, because you deserve to know who benefits from your confusion. The wide ratio, the cheap silver, the quiet signal nobody discusses. All of it exists in a market where the price is set not by the metal you can hold, but by mountains of paper claims traded on exchanges. And the people who run those exchanges have a very old habit. When something threatens to run too hard in a direction that costs them, they can raise the cost of holding a position. We watched this happen not long ago, when silver was climbing hard and the exchange abruptly hiked the money required to hold it. And the price fell sharply in a matter of days, even though not 1 ounce of real-world supply or demand had changed. Nothing fundamental moved. Only the cost of holding paper moved. The exchange did not change the metal. It changed the rules around the metal, and it broke the run. Remember that the next time you see silver take a violent tumble, and everyone tells you the story is over. Ask who moved the cost of holding, and ask who profited when you got scared and sold. This is why I keep coming back to physical metal, real ounces you actually own, versus a paper promise you merely hold. A generation of savers has learned the hard way that a piece of paper that says you own something is not the same as owning it. And when the paper price and the physical reality finally disagree loudly enough, it is the people holding the real thing who are standing on solid ground. The whole architecture of the modern metals market is built to keep you trading the paper and thinking that is the same as owning the metal. It is not. Now, I want to be honest with you, because there are plenty of people online who will not be. A wide ratio is not a magic guarantee. It has been wide before and stayed wide for a good while before it snapped. Silver is volatile, more volatile than gold, and it can absolutely fall further before it does anything else. There are real cross-currents right now, even in the demand story, places where users are learning to use a little less silver per device. This is a case built on history and structure and the behavior of the biggest buyers on Earth. It is not a promise. It is not a prediction of a price by a date, and nothing I say here is personal financial advice. Anyone who hands you a number and a deadline is selling you certainty that does not exist, and that is its own kind of trap. But a case can still be strong, and let me stack up why this one is. The ratio is stretched wide, which is the setup. Underneath silver sits a multi-year structural deficit that supply cannot quickly fix. Above it all, The central banks keep buying gold at a record clip, and they accelerated their buying after the world watched one major nation have its foreign reserves frozen, a moment that taught every government on Earth a lesson they will not forget. Gold in your own vault cannot be frozen by another country. Meanwhile, the old rules that used to govern gold have quietly broken. For decades, the textbook said gold should fall when other safe investments started paying more. Lately, gold has climbed anyway, right through conditions that used to knock it down. When the old inverse rule stops working, it usually means something larger has changed underneath the surface, something the models have not caught up to yet. And here we are, with policymakers themselves divided. The Fed under Kevin Warsh made its latest decision to hold steady, and the striking thing was not the decision, but the split behind it. A divided set of officials pulling in different directions. Some worried inflation is still too warm to relax. When the people who are supposed to have the clearest view of the economy cannot agree with each other, that uncertainty does not vanish. It has to go somewhere. Historically, some of it goes into the one asset that is nobody else's promise, the metal that does not depend on any committee getting it right. Let me pull the thread on how far silver can be pushed around and still come back, because it is remarkable. Silver has touched roughly the same ceiling, that famous $50 level, twice across the decades, more than 30 years apart, and the base underneath that ceiling is something like 45 years of history. Think about what that means for a moment. An investor who bought at the peak of the first run and adjusted for what inflation did to the dollar over the decades that followed has still, in real terms, never been made whole. The nominal number gets all the attention. The real value, what those dollars actually buy, tells a quieter and more important story. Silver has spent an extraordinarily long time coiled beneath a level it has proven, twice, that it can reach. So now let me tell you the thing I most want you to take from all of this. And it is not a price. It is a position. Right now, you are early. I do not mean that as a sales line. I mean it as a plain description of where we are. The central banks already understand what the wide ratio and the record buying are telling them, and they are acting on it, quietly, month after month. The smart money watches this exact signal and does not announce it. But the mainstream, the pension funds, the financial channels, the neighbor who asks you for stock tips at a barbecue, they have not caught on. Silver is not on magazine covers. There is no line around the block at the coin shop. There is no mania. And a mania is what tops look like, not what beginnings look like. And that is precisely the point. By the time this ratio and this metal are obvious to everyone, by the time it leads the evening broadcast and every advisor in the country is recommending it, the easy part of the move will already be behind us. The people who did well in that spring panic did not get a phone call telling them to hold. Nobody sends you an invitation to be early. There is no announcement. The whole nature of being early is that it feels lonely and uncertain and a little foolish, right up until the moment it suddenly feels obvious to everyone at once. And by then, the window has mostly closed. We are not in that obvious moment yet. That is not a reason to wait. That is the entire reason it matters now. So here is what to actually do with your own position, in plain principle, not prescription. Own the metal, not a paper promise that merely represents it. Size whatever you hold so that a sharp drop, and there will be drops, can never force you to sell. Because forced sellers into a shakeout are the ones who get hurt, every single time. And whatever you do, do not sell into the panic. The man who felt like a fool in that spring lockdown was only a fool if he sold. He held, and the ratio snapped back, and the metal that had been marked down the most is the metal that ran the most. That is the whole lesson of this quiet little number, wrapped up in one human decision, to not flinch. If you have watched me all the way to here, then this last part is for you specifically, because you are exactly the kind of person who thinks before acting. For folks with $100,000 or more in a retirement account who made it to the end of this video, I offer a free one-on-one educational web conference. It is not a sales call. It is a chance to sit down with a real person and walk through how this actually works for your situation, how the precious metals IRA fits, what makes sense and what does not. And the honest reason to do it now, while nothing feels urgent, is exactly that. The best time to understand your options and make a calm, clear-headed decision is when the world is quiet, not when it is screaming and everyone is panicking at once. That calm window is open right now. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and mention that you watch this all the way through. Because at the end of the day, the ratio reached a level almost nobody noticed, and that is the tell. Not the number itself, but the sirens around it. The people who profit from your fear are perfectly happy for you to keep staring at the gold price and never learn to read the quiet signal underneath. You just get. You understand now what a stretched ratio has meant every time it has stretched this far. And you understand that the metal luck for Ged has a long history of coming back the hardest. Nobody rang a bell. Nobody sent a memo. It happened quiet, the way the important things usually do. And now you are one of the few people paying attention, while it is still early enough to matter.